Hello everyone. As most of us know, in 2025, FII has been selling like crazy, and as of September 2025, they have already pulled out more than 1.3 lakh crore rupees from Indian market. That's roughly 15 billion US dollars. I mean, to be honest, it's a little bit alarming and making Indian investors worry about this massive outflow. But when I looked deeper into the data, there are some historical patterns and revival signs. Hence, in this video, I would like to discuss why I believe most probably FIIs will become buyers in November or December 2025. And I'm not just saying this randomly, I will present 5 major reasons. So please consider watching the video till the end, since for some the first point might be useful and for others the fourth point might be useful. Hence, at the end of this video, we will know more fundamentals about the market and we will understand why in November or December 2025 FII might turn bias. So without delay, let's get started. First, the flow cycle exhaustion. See, if you look at FII flow patterns over the last 10 years, there is a very clear cycle that keeps repeating. If required, please pause and have a look. In 2016 and 2017, they were net buyers. In those 2 years, they bought around 70,000 crore rupees. Then in 2018, FII sold 34,000 crore rupees. But guess what happened in 2019? They bought 1.01 lakh crore rupees. Again, in 2022, they sold 1.21 lakh crore rupees, and in 2023, they bought more 1.71 lakh crore rupees. I mean, every single time FIIs have had a major selling phase, they have come back even stronger within 9 to 12 months. It's like clockwork. Now in 2025, they have sold 1.3 lakh crore rupees so far. Hence, as per that pattern, we could expect them to come back aggressive. So that is positive. But here too, there is a catch. In the last 2 years, each year DI pumped like 5 lakh crore rupees into the Indian market. And in the last 4 years combined, DI invested a massive 15 lakh crore rupees. Hence, in a way, unlike previous cycles where FII selling created panic, this time the market is still up 6 to 7% in dollar terms. That's an annualized return of 11 to 12%. And in the last 2-3 months monthly data, we can clearly see the selling exhaustion. The volume is reducing. Hence, potentially either in November or December, FII might start buying again. Then the second reason, the China-India valuation story. I mean, from FII's eyes, India and China both are emerging markets. When they allocate funds for emerging markets and they look at relative valuations. And India's market always trades at a premium to China because of the domestic structure. With that in mind, let's look at the data. Back in 2020, India's premium to China was just 5 times on 12-month forward PE ratio. That in 2021 increased to 9. Between 2022 and 2024, India was trading at a massive premium to China, around 10 to 11.5 PE ratio turns higher. So it's a huge premium. But in 2025, it's changed. China's market 12-month forward PE ratio increased to 13.8 times on AI hopes and policy support, while India moderated slightly to 20 times. So the gap has now narrowed to just 6 PE ratio turns difference, which is the smallest since 2020. So, global fund managers who were underweight India because of expensive valuations relative to China now have a reason to come back. Then, third, the gold wealth effect. This is something most analysts are completely missing, but it's absolutely crucial for understanding India's resilience. Indian households hold approximately 25,000 to 27,000 tons of gold. At current price of gold, 4,000 US dollar per ounce, that's worth around 3.5 trillion US dollars, which is 80% of India's GDP. It's a massive wealth now. Just 3 years ago, this same gold was worth only 1 trillion US dollars. Hence, Indian households have massive global relative wealth appreciation like 20 to 30%. Now, you might ask, so what? How does this relate to FIIs? Here is the brilliant part. I will give a personal example. See, this happened in my family. They didn't sell their gold. Instead, they pledged it as a collateral for loans and then they bought land as an investment with that money. So, from the macroeconomic point, household gold starts to turn the economic cycle. It's a complicated macroeconomic concept, but let me simplify. The amount of money RBI could print is based on the productivity of the people. So, whatever people in the country do is the money RBI prints. For example, instead of using a debit card, every time when people use a credit card, they are creating money and RBI could use the transaction to print the equivalent rupee currency. Hence, in that way, household gold has now started to act like a credit card. I mean, in 2022, gold loan outstanding was 61,000 crore rupees. That in the last financial year, FI 2025, increased to 1.8 lakh crore rupees. That's a 200% increase in just 3 years. And I'm expecting even more this year. I mean, families are using gold to get bank credit for buying land, expanding business, or purchasing consumer durables. It's turning into productive liquidity. So it's increasing the consumerism. And since most of these are gold backed loans, the credit risk for banks is minimal and it's increasing the banking business. We know Nifty is made of banking stocks which accounts for 35%. Hence, this gold driven liquidity provides the cushion that makes India attractive even during global volatility. Fourth, let's discuss GST 2.0, which I believe will be the structural trigger for the next positive run. I mean, in Q1 2025, 40% of the companies missed the analyst estimates, whereas in Q2 2025, it dropped to just 20%. So, 80% of the companies beats the estimates. Part of the reason GST 2.0. See, it was implemented only from September 22nd, 2025, but it was announced on August 15th itself. Hence, generally, people's financial behavior was postponing the purchases to October month. Hence, all that positive influence we will see in the next quarterly results, which again FII knows as well. So I'm sure they don't want to be shorting the stocks. Finally, let's address the elephant in the room, the rupee value. If required, please pause and have a look. Here, the bar charts are RBI's net forward US dollar position in the currency derivative market and the line graph is India's Forex reserve. Before 2024, RBI had long positions in US dollar INR derivatives. They bought massive quantities like 40 billion US dollars by selling the rupee. Whereas in 2024, they started to sell the dollar and until July every month, they held around 20 billion US dollars worth of short positions, which is not good. But after July 2024 until September 2025, it's even worse. RBI is holding massive 50 to 60 billion US dollars short positions and this is making FIIs nervous. Since it's a short position, when RBI buys those dollars back, they have to sell the rupee which might depreciate the rupee further. However, usually RBI's guidance is to have 8 to 10 months of merchandise goods import cover as forex reserve. And as per this graph, they have like 11.3 months cover and based on yesterday's data, they have like 12 months worth of import cover, which is really huge and I don't think they want to increase the forex reserve any further. Hence, considering no further forex reserve increase, RBI could easily reduce this massive short position in the next 6 to 8 months with the help of balance of payments. Please remember, despite the merchandise exports, because of remittance and service exports, for most of the time, barring 1 or 2 months here and there, India has a balance of payments surplus. So, considering that and RBI's real effective exchange rates and nominal effective exchange rates, I calculated the fair value of the rupee, which comes to 82 rupees per US dollar. But at present, it's trading at 89 rupees per US dollar. Hence, the rupee is undervalued by 7 to 9%. Here, please note, I'm not saying the rupee won't fall further because for a long time the market can be irrational. Rather, what I'm saying is fundamentally the rupee is undervalued. In summary, we discussed 5 things. 1. FII buy sell cycle favoring buying. Second, the relative valuation of India and China is now back in favor of India. Third, increasing gold price is fundamentally a boon for India and it's influencing the consumer cycle. Then fourth, a positive influence of GST 2.0 related earnings optimism. And finally, fundamental strength of the rupee. Hence, because of all those reasons and not factoring the uncertainty, I think FI might come back buying in November or December. But please remember, I haven't included any geopolitical influence like India US trade deal or India Europe trade agreement, since that could change things in any direction based on what India gets. And also, it's just my opinion, I could be completely wrong. So that's all in this video. Hope you got some useful information. Please consider subscribing the channel and liking the video so that it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investment decision based on this, as I'm not a SEBI registered advisor. I'm doing this for me and viewers educational purpose only. Thanks for watching.